Corporate finance practice problem using OneNote. Dividend payout policy analysis. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote and would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side, Practice Problems tab, then down in the 1819 Dividend Payout Policy Analysis tab. Also note, when using OneNote, look at the immersive reader. Our presentations up top will be down in the text area as well. Same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top, calculations then on down below. We're going to be doing an analysis of two different dividend policies. We're going to imagine those two policies over the 5-year period and then think about them in terms of the present value of the cash flows of those policies as they might be considered by investors looking for their return in the form of dividends, and looking at one plan, Plan A, which has a fairly stable type of plan in the future. So we'd be projecting in Plan A dividends in year 1 at 1.7, dividends in year 2, 1.7, year 3, 1.7, year 4 jumps up to 3.1, year 5, 3.1. So, and then in Plan 2, we have a more volatile type of dividend strategy that's going to bounce around a bit. Year 1 at 50 cents, year 2, $3, year 3, $1.50, year 4, $3.50, and year 5, $4.50. Now, note Plan 2, again, jumps around a bit more. So we're going to imagine then, from an investor standpoint, they might consider Plan 2 to be a bit more risky due to that jumping around of the dividends. Most of the time, the investors like a nice even plan. They would expect a nice even, flow of income, nice even flow of the dividends. When things start to jump around, they might see it as more volatile. And therefore, when we do the present value calculation, we're going to estimate that the Plan 2 might have a higher discount rate than Plan 1. So we're going to think about the present value of the dividend stream and apply a higher rate to year 2 or Plan 2 due to the volatility or jumping around of the rates as opposed to Plan 1, which is going to be more stable. Now, if we were just simply to add up the dividends for the two items, we would have the $1.70 for the 3 years and then the $3.10 for the two later years. That would add up to $11.30 versus Plan 2 with the more volatile payment structure ending out at the $13. So Plan 2, of course, higher with regards to the total dollar amount over the 5-year period. However, we want to do our discount policy of the cash flow stream. Now, remember, we're going to be doing present value calculations of this. If you want to just work on present value calculations, if you're a little rusty on those, go back to the section where we look at present value calculations, because you could see those in multiple different ways. You can do the present value calculation by a formula. You can do present value calculation with a table. You can do present value calculation with Excel. We're going to focus on just doing the Excel calculation here, how it would be done in Excel. Also note that you got to kind of visualize when you would do present value of 1 calculations versus an annuity type of calculations and get those straight in your mind as well, so you can work on that chapter for more there. Also note that we do work these kind of problems in the capital budgeting type of area where we have future cash flows, and we're going to use different strategies to bring them back and present value them using net present value and possibly internal rate of return type of calculations in a prior section as well. We're going to use those same kind of concepts, present value, in our plan for the dividend strategy here. Okay, so if we go on down, we're gonna map this out. We'll say the present value for years 1 through 5. We're going to look at Plan 1 first. This is going to be the stream of income, the more even stream of income, where we have the $1.70 for years 1 through 3, and then the $3.10 for years 4 and 5. We will present value them using our present value. This would be the formula on the right, which would be basically in Excel. But the concept then would be, this is going to be 1 year out. We want to bring it back to period $0 so that we can kind of compare it in terms of 0 period dollars. Here we're using the discount rate at the 11% due to this being a more stable structure, and therefore using a lower discount rate to bring it back. The higher rate because of the more risk for the second Plan 2 item. So the formula is going to be equals, we got the negative present value, the rate is going to be that 11%, so we're discounting the 170 at 11% back one period. Then we have the number of periods, which is going to be 1. Note that the number of periods here, we used a formula here in this cell instead of hard coding or typing in the number 1, and that allows us to copy it down. So if you do this in Excel, and we do have this problem in Excel, and you just want to work on Excel formatting, that'll help you to basically copy it down. Also note that this first one, which is representing this 11%, has a $sign before the B and 11, allowing us to copy it down without moving that cell coming from a fixed standpoint that would be outside of our table. And then we do not have a payment here, so you see 2 commas because there's no payment. And then we have the future value, which is going to be that cell right there, the 170. So we're bringing back the 170 at the discounted rate of 11% for 1 period or 1 year to get us to 153. If we did the same thing for year 2, 170 discounted back at the 11%, now 2 periods or 2 years, formula looks like this, negative present value of the rate. Notice we have the same cell here. That's the same 11%. That's what the $signs do. It allows us to copy it down and not move the rate cell. Notice that the cell for the payment did move down from E3 to E4. That's going to be not the payment, the number of periods. This is the number of periods that we're on. And that moved down from 1 to 2. So we don't have to hard code or type in the 2 here. We just copied it down. Then we got comma, comma, because there's no payment. Future value is that 1.7. So the 1.7 discounted back 2 years is the 1.38. Same thing here. The 1.7 discounted back 11% 3 periods is the 1.424. And then we're jumped up in the dividends in year 4 to $3.10, discounted back 4 years at the 11% discount rate gets us to $2.04, and then the $3.10 discounted 5 years back at the 11% would get us to the $1.84 for a total. If we sum up this column, years 1 through 5, on the present value, we get the $8.04. So total dollar value over the 5-year period, $11.30. Present valuing it using our discount rate at the 11% gives us the $8.04. Now let's do the same kind of thing using the second one, our second series of numbers here, which were, and let's bring this on down. I'm gonna copy this, see if I can bring that down here, and we could see it a little bit. So we're gonna copy this series of numbers down, and so we got periods 1 through 5, and now we got this more volatile series of dividend payments, or ones that change more often. So if we present value the first one back, now we only got 50 cents in year 1. Same present value calculation, present value of the rate, but this time the rate is going to be the 15% because it's a higher rate due to the higher volatility, which will result in a lower number than we would have if using the 11% on this series of numbers. So then we're going to say comma, and also notice, once again, we have the absolute value $sign before the B and the 12, so that when we copy it down in Excel, it would copy down easily and keep the same cell. And then we got comma, the number of periods, which is going to be 1, which is this cell. Note we didn't hard code the 1 or type it in there, but rather used that cell over there so we can copy it down. Then we have comma, the payment, which we don't have a payment, so 2 commas. And then we have the future value, and that's because it's not an annuity. That's why we don't have a payment. Future value is the 50 cents. Present valuing the 50 cents back at the 15% rate gives us the 43 cents. Then if we take year 2, we got $3, which we're going to discount back at the 15% for 2 years, giving us the 2.27. That calculation, negative present value of the rate, which is the same cell. You can see that's what the absolute or $signs do. That's that same 15%, comma, number of periods, which is now 2, now represented by a formula. That formula that cell has changed, E12 to E13, which would do automatically to copy it down because it's not an absolute reference. No payment. And then the future value also copied down from F12 to F13, which is now this $3. If we did that all the way across, we got the 1.5 discounted back 3 years at the 15% gives us the 0.99 or 99 cents. We got the 3.5, $3.50 discounted back at the 15% for 4 years gives us $2. We've got the $4.50 discounted back at the 15% discount rate for 5 years gives us $2.24. So then if we were to add up the present value in this column, then we're at the $7.93. So $7.93 versus if we were looking at just the cash amount at the $13. Now in year 2, this second one, of course, we use the higher discount rate, which means we're going to end up with a lower end result value. And that's, once again, taking into consideration what we would consider the higher risk because of the kind of volatility between the bouncing around of the dividends that we expect to be happening, which we're assuming would result in more risk. And that results, even though we had the 1130 up top versus the 13 for total dollar amount of dividends, we end up with the first one being a better choice possibly, given the fact of the higher discount rate due to what would be considered the volatility or the risk involved, the 8.04 being higher than the 7.93. And that would mean that the first scenario would look better under the conditions that we put in here because it has a higher present value calculation.